Good evening to all TradingLink partners. We've reached our weekly trading sharing session once again. Today is January 18th, 2025, Singapore time 12:40 a.m. Let's start by looking at this week's star trading asset. Bitcoin, on Monday, experienced a significant drop alongside other major market assets like the US dollar index and gold. However, it quickly regained its losses during the US trading session. For the next 4 consecutive days this week, it surged rapidly, nearing its previous high of 127,000. This movement was somewhat predictable. As we've mentioned before, leading up to Trump's inauguration, we expected a swift breakout above the previous highs. The market action over the weekend is worth watching as Bitcoin might break through the earlier high of 108,000. On Monday, the daily chart found support at its lower boundary, forming a particularly long lower wick. The length of this lower wick exceeded $5,000. By Tuesday, there was already an opportunity to start building long positions. Thursday's washout saw another long lower wick at the close. Today also presented a good entry opportunity. This trading momentum, dubbed Trump 2.0, reflects market expectations of fresh highs for many assets following Trump's inauguration. Bitcoin, however, is unique as it continues trading over the weekend. This weekend's market will be a focal point for the week, but caution is advised for potential sharp corrections on Monday. For this round of trades, experience teaches us how to handle it. Once a breakout occurs, we can set a stop loss at the previous high of 107,000. We aim to capture the continuation of the bullish move after the breakout. If there's a false breakout followed by a pullback, setting a trailing stop at the previous high of 108,000 ensures profitable exits. The next 2 days for Bitcoin's price action are highly anticipated. The trend remains robust, well-structured, and strong. This aligns with our earlier analysis that a second wave of upward movement would coincide with Trump's inauguration. The second asset this week is somewhat peculiar. Gold, on Monday, formed a significant bearish candle. This bearish candle was triggered by a descending resistance line connecting the highs of October 30th and December 12th. On Friday, gold faced resistance precisely at 2,735. At this level, many discretionary traders within TradingLink initiated short positions. The entries were well positioned, with precise timing near the highs. In last week's session, we analyzed a trader's signal, which also performed well on Monday. However, after yesterday's breakout above the resistance line, most traders' orders were stopped out. Today, these traders joined in to share their weekly insights. They felt that this round of gold's bullish movement was unusual and somewhat defied technical patterns. This could be attributed to the market hype surrounding the Trump 2.0 narrative. Overall, gold may not be as strong as Bitcoin. There is a possibility of a downward correction at the beginning of next week. From both monthly and quarterly perspectives, gold lacks the potential for a rapid surge to break previous highs. Gold's high valuation, along with its dependency on the US dollar index, imposes limitations. Over the past 2 weeks, gold has moved in positive correlation with the dollar index. This is one of the most confusing aspects for the market. For instance, this week, the dollar index found support at its moving average and remains within an upward channel. However, gold has also risen for 3 consecutive weeks, including the final week of last month. With this pattern emerging, many believe an accelerated decline testing the 40-week moving average may occur. Yet, at the weekly level, a support line can still be identified. As observed, gold found support at the midline of the Bollinger Bands on the weekly chart. Once this type of movement begins a downward trend, it might coincide with other markets, like China, breaking out. Thus, caution is warranted for such potential patterns. Gold, unlike Bitcoin, is not as heavily influenced by US political developments. Instead, it has displayed an unconventional trend. Therefore, this bullish movement requires cautious handling. After all, at the daily level, it is clear that prices are repeatedly facing resistance at the upper band and pulling back. This is the 4th time in recent months that it has tested and broken the upper band. Is it possible for gold to break away at the daily level, surpassing its previous high of 2,800 and heading toward 2,850 or even 2,900? Personally, I believe the probability of this happening is low, as gold's overall momentum is not that strong. After all, gold lags behind crude oil. As we mentioned earlier, crude oil had consolidated for months at a low of around $70. The bottom was well formed, and the yearly trend was in a downward trajectory. This recent rally can be described as a retaliatory rebound. It broke past the previous high of $81.16 from October 11th. Additionally, Trump's sanctions on Iran and Russia after taking office added significant uncertainties. This allowed crude oil to benefit greatly from geopolitical developments. The decline in the U.S. inflation CPI index during this period also provided some support for crude oil. As you can see, crude oil remains strong at the weekly chart level. The 5-week and even the 4-week moving averages have not been tested from below. Currently, the bullish candle is a full-body type, which indicates continued strength. Overall, both crude oil and Bitcoin present a more ideal bullish pattern compared to gold. Thus, caution is advised for potential sharp bearish movements in gold next week. Additionally, gold's current movement appears strained and unconvincing. Although the bullish candles continue, no solid pullback has been observed. This pattern likely represents the final stage of an Elliott wave, barely holding on. This indicates that the risk of chasing the market at this stage remains relatively high. For our more skilled traders, last week and this week were essentially break-even or small stop-loss periods, with no significant gains. However, it's better to have missed the bottom than to be trapped at the top. As you can see, over the past 3 weeks, gold's movement has shown some patterns. For instance, gold tends to form a weekly low on Monday, followed by a slight uptick on Tuesday. Then, from Tuesday through Friday, it experiences a rapid, trapping rally. The week before last, Tuesday also showed strong concealment with a spike and retreat near the closing. On Wednesday during the Asian session, it quickly trapped traders, and this pattern persisted for 3 consecutive weeks. This has been driven by anticipation and manipulation around the bearish momentum seen in prior significant down candles. Thus, this bullish wave seems relatively aggressive. Overall, for these financial instruments, the volatility risk remains significant. For instance, with Bitcoin, if you're caught in a short position on a contract, it could result in irreversible losses. In leverage markets and global mainstream instruments, it's crucial to implement strict stop-loss and liquidation strategies. If you misjudge the direction on a weekly chart, you might end up with no gains for the entire week. If you close your positions, you might still have opportunities to re-enter next week. Therefore, everyone should remain vigilant about overall trading risks. As we enter 2025, we hope all traders can maintain a better mindset and adhere more strictly to their trading disciplines and refine their trading models. If you happen to miss out on this type of event-driven market, I don't think there's anything to regret. After all, these event-driven opportunities are rare across the 300-plus trading days in a year. Of course, in every market condition, managing your risk is paramount. For example, take today's gold price. Why does the 4-hour bearish candle suddenly reverse direction in the next one? For many traders who rely heavily on technical analysis, this is a frustrating phenomenon. After 5 consecutive bearish candles on the 4-hour chart, a corrective move is expected, and the channel should have formed. Thus, the one-sided trends in gold and Bitcoin don't adhere to technical patterns as neatly as crude oil or currency pairs. Their movement tends to be more erratic and sometimes resemble crash-like patterns. That concludes our overall analysis for this week. On Sunday, Trump will hold his inauguration ceremony. On Monday, there may be significant market fluctuations, whether in profit or loss. We hope that after Trump's inauguration in the new week, there will be stable market movements. Hopefully, this will prevent traders from being caught in overly passive positions. Alright, that concludes this week's discussion. Thank you all for listening. See you next week.